When a recession hits, the media shows you lines at unemployment offices, families losing homes, businesses closing, and workers facing impossible choices between paying rent and buying food. The story you're told is that recessions hurt everyone, that economic downturns are shared sacrifice, that we're all in this together struggling through hard times until recovery arrives. But that story is a lie, or at best a half-truth that obscures the most important dynamic of every recession in modern history. They transfer wealth upward, from ordinary people who lose jobs and homes and savings to the wealthy who have cash and access to credit and the political connections to ensure government rescue programs benefit them disproportionately. The data is unambiguous. During the COVID-19 pandemic and recession, America's roughly 700 billionaires increased their collective wealth by $1.7 trillion, a 58% gain in 3 years while millions of workers lost jobs, small businesses closed permanently, and households burned through savings. After the 2008 financial crisis, inequality declined temporarily during the recession itself as asset prices crashed. But by 2016, 8 years into recovery, inequality had reached new highs as financial assets rebounded while wages and home equity stagnated for the bottom half of Americans. The pattern repeats across every recession. Asset prices crash, panicked or desperate sellers liquidate at the bottom, wealthy buyers with cash or credit purchase assets at fire sale prices. Government stimulus and bailouts reflate asset prices, and the wealthy who bought at the bottom profit enormously while those who sold or lost assets are permanently impoverished. Understanding how the rich profit from every recession means recognizing that economic crises aren't natural disasters that hurt everyone equally. They're mechanisms of wealth transfer, often deliberately engineered through monetary and fiscal policy that concentrate ownership and power while impoverishing those without the resources to weather the storm or the connections to access bailouts. The recession isn't coming to hurt you, it's coming to enrich those positioned to profit from your desperation. The 2008 financial crisis provides the clearest case study of recession as wealth transfer because it's recent, extensively documented, and the mechanisms are so blatant they're almost caricatures of predatory capitalism. The crisis was caused by Wall Street's reckless lending and securitization of subprime mortgages, creating financial instruments so complex and risky that when housing prices stopped rising, the entire system threatened to collapse. Banks and investment firms that had made billions in profits during the bubble suddenly faced insolvency as mortgage-backed securities became worthless and counterparties demanded payments on credit default swaps and other derivatives. The government response was swift and unprecedented as shit. Trillions in bailouts through TARP, Federal Reserve Emergency Lending Facilities, guarantees of bank deposits and money market funds, and ultimately quantitative easing that pumped trillions into financial markets. The explicit justification was preventing total financial system collapse. The effect was saving financial institutions and their wealthy shareholders and bondholders from losses while doing relatively little for homeowners facing foreclosure or workers losing jobs. The numbers reveal the transfer. The Troubled Asset Relief Program injected $700 billion into banks and financial institutions, most of which was eventually repaid with interest. But TARP's structure ensured banks were saved on favorable terms while homeowners weren't. The Home Affordable Modification Program, designed to help homeowners avoid foreclosure, was vastly underfunded relative to TARP and helped only about 1 million homeowners permanently out of millions facing foreclosure. Many banks that received TARP funds continued foreclosing aggressively on homeowners while simultaneously receiving government support for their own balance sheets. The Federal Reserve's actions were even more consequential. Through quantitative easing, the Fed purchased trillions in Treasury securities and mortgage-backed securities, effectively creating money to buy these assets and driving their prices up. This policy was explicitly designed to boost asset prices, which it did spectacularly. Stock markets recovered from 2009 lows to reach new highs by 2013. Bond prices soared as yields fell. Real estate in desirable markets recovered and then exceeded pre-crisis peaks. But these were all assets disproportionately owned by the wealthy. The wealthiest 10% of Americans own roughly 89% of all stocks, 91% of all bonds, and a disproportionate share of real estate beyond primary residences. When the Fed's policies inflated asset prices, the benefits flowed overwhelmingly to the wealthy. Meanwhile, the bottom 50% of Americans who hold most of their limited wealth in home equity and have minimal stock or bond holdings saw home values recover slowly or not at all depending on location, while wages stagnated. The result was exactly what the data shows. Inequality declined temporarily during the 2008-2009 recession as asset prices crashed. But during the recovery from 2009 to 2016, inequality not only returned but exceeded pre-crisis levels as asset price inflation enriched the wealthy while wage and employment growth remained weak for most workers. Federal Reserve Chair Janet Yellen acknowledged this in 2016, noting that whereas recovery from the Great Depression was accompanied by narrowing inequality, the post-2008 recovery saw inequality rise to near their highest levels in the past 100 years, probably higher than for much of American history before then. This wasn't accidental or an unfortunate side effect. It was the direct and predictable consequence of policy choices that prioritized rescuing financial institutions and inflating asset prices over supporting workers and homeowners. The wealth transfer through asset purchases at distressed prices is the core mechanism. During every recession, asset prices crash as panic selling drives values below fundamental worth. Stocks that were trading at $100 fall to $30. Homes worth $500,000 sell for $300,000 in foreclosure. Businesses that were profitable close and sell assets for pennies on the dollar. These crashes hurt asset owners, initially including the wealthy. But the wealthy have two critical advantages. They have cash or credit access to buy assets at depressed prices, and they have the time horizon to wait for recovery rather than being forced to sell at the bottom. The typical middle-class household facing recession loses income through unemployment or reduced hours. They draw down savings to maintain spending. When savings are exhausted, they sell assets, often at the worst possible time when prices are lowest, to raise cash for immediate needs. A homeowner facing foreclosure sells or loses the home when prices are depressed. A worker cashing out a 401k early to cover living expenses sells stocks at market lows. These forced sales at depressed prices transfer assets from distressed sellers to cash-rich buyers at enormous discounts. The wealthy, by contrast, have sufficient liquidity to avoid forced sales. They can hold depressed assets through the downturn, waiting for recovery. Even better, they can be net buyers during the crisis, purchasing assets from distressed sellers at fire sale prices. This requires cash or credit access, which the wealthy have both directly and through connections to financial institutions that continue lending to creditworthy borrowers even during crises. Private equity firms, billionaire investors, and wealthy individuals deployed tens of billions buying residential real estate in foreclosure during 2008-2012, becoming landlords renting to the same families they'd bought the homes from. They purchased distressed commercial real estate, bought stakes in struggling companies, and accumulated financial assets at prices that would generate enormous returns when recovery arrived. The recovery phase is when the wealth transfer is fully realized. Asset prices reflate, driven by monetary stimulus, government support, and eventual economic recovery. The stocks purchased at $30 return to $100, then $150. The homes bought for $300,000 in foreclosure sell for $600,000 a decade later. The businesses acquired cheaply during crisis become profitable again. The wealthy who bought at the bottom realize enormous gains. And critically, these gains compound over time through dividends, rents, and reinvestment, concentrating wealth further. The COVID-19 pandemic and recession demonstrates that the 2008 pattern wasn't unique, but is the standard playbook for how recessions transfer wealth. When the pandemic hit in March 2020, stock markets crashed, losing roughly a third of their value in weeks. Unemployment spiked to levels not seen since the Great Depression, reaching nearly 15% within months. Businesses, particularly small businesses, faced existential threats as lockdowns eliminated revenue while costs continued. The government response was massive, trillions in stimulus through CARES Act and subsequent legislation, providing direct payments to individuals, enhanced unemployment benefits, PPP loans to businesses, and Federal Reserve intervention even more aggressive than 2008. The Fed purchased assets at unprecedented scale and speed, expanded its balance sheet by roughly $5 trillion, and directly supported corporate bond markets to prevent a liquidity crisis from becoming a solvency crisis. The result? America's roughly 700 billionaires increased their collective wealth by $1.7 trillion, or 58%, during the approximately 3 years of the federally declared COVID pandemic, from $2.9 trillion in March 2020 to $4.7 trillion. This wealth gain exceeds the entire net worth of the bottom half of American society, roughly 165 million people. Individual examples are staggering. Elon Musk's wealth grew over sevenfold to more than $150 billion, Larry Ellison's doubled to over $60 billion, and Michael Bloomberg's doubled to $46 billion. The top 1% of households saw their wealth increase by roughly 30% during the pandemic period, while median household wealth barely grew and the bottom 50% saw minimal gains or losses. How did billionaire wealth increase 58% during a recession that devastated millions? Through the same mechanism as 2008 asset price inflation driven by monetary stimulus. The Federal Reserve's aggressive interventions drove stock markets to new all-time highs by late 2020 despite the economy being in severe distress. Bond prices soared as interest rates fell to zero. Real estate prices, after a brief pause, accelerated to rates not seen in decades. And because the wealthy own the vast majority of these financial assets, they captured the vast majority of gains from asset price inflation. The mechanism is almost comically simple. Federal Reserve creates trillions in new money. That money enters the financial system through asset purchases and lending to banks. Banks and financial institutions use that money to buy stocks, bonds, and real estate. Asset prices rise. Wealthy people who own those assets become wealthier without producing anything, creating anything, or adding any value to society. Meanwhile, workers who don't own significant financial assets see minimal benefit despite their wages being the income that makes corporate profits possible. The pandemic revealed another dimension of wealth transfer: consolidation. Small businesses faced lockdowns and capacity restrictions that large corporations could absorb but small operators couldn't. A local restaurant with thin margins closed permanently after months of zero revenue. Amazon, already dominant, saw revenues and stock price soar as consumers shifted to online shopping. Small retailers closed. Walmart and Target thrived. Independent hotels faced bankruptcy. Major chains bought them in bankruptcy for pennies. The crisis accelerated consolidation across industries, transferring market share and assets from small operators to large corporations, which are disproportionately owned by the wealthy through stock holdings. The Paycheck Protection Program, designed to help small businesses maintain payrolls, revealed the capture of government programs by those with resources and connections. While many legitimate small businesses received needed support, investigations found that substantial PPP funds went to businesses that didn't need them, that misused funds, or that were connected to wealthy individuals who exploited the program. Large restaurant chains with wealthy owners received millions, while many actual small businesses were shut out. The program's rushed implementation and limited oversight ensured those with sophisticated accounting and legal resources could navigate the system, while unsophisticated small operators struggled. The pattern extends beyond the 2008 and 2020 crises to every recession in modern history. The early 2000s recession following the dot-com crash and 9/11 saw similar dynamics. Asset prices crashed, wealthy investors bought at lows, Fed stimulus reflated prices, and inequality increased during the recovery. The 1990-1991 recession created opportunities for wealthy real estate investors to buy commercial property at distressed prices. The early 1980s recessions, while painful for workers facing high unemployment, created opportunities for corporate raiders and private equity firms to acquire companies cheaply and restructure them for profit. The specific mechanisms vary slightly across recessions, but the pattern is consistent. Access to credit during crisis. Banks reduce lending during recessions to manage risk, but they never stop lending entirely. They continue lending to the wealthiest, most creditworthy borrowers. This asymmetric access to credit means the wealthy can buy assets during crises while ordinary people face credit restrictions. Someone with substantial assets and high credit score can get financing to buy real estate or businesses at depressed prices. A working-class family facing unemployment can't get a loan at any interest rate. Government bailout structure. Bailout programs consistently favor financial institutions and large corporations over individuals and small businesses. TARP rescued banks. Auto bailouts rescued GM and Chrysler. PPP provided some small business relief, but with significant leakage to larger entities. But homeowner relief programs are underfunded and ineffective. Unemployment benefits are temporary and insufficient. Student debt isn't addressed. The pattern reveals whose interests drive policy. Tax treatment of losses and gains. The tax code allows wealthy investors to deduct losses during downturns, reducing their tax obligations when asset values fall, but then tax gains at preferential capital gains rates when assets recover. Ordinary workers can't deduct their economic losses, their reduced wages, or lost jobs. They pay taxes on whatever income they have throughout. This asymmetric tax treatment amplifies the wealth transfer by allowing the wealthy to socialize losses through deductions while privatizing gains through preferential tax rates. Dividend and buyback benefits. Corporations continue paying dividends to shareholders and often resume buybacks quickly after crises, transferring cash to shareholders who are disproportionately wealthy. During recessions, these corporations often lay off workers, cut wages, and reduce investment while maintaining or quickly restoring shareholder payments. This prioritization of shareholder returns over worker welfare transfers value from labor to capital, enriching owners at workers' expense. Real estate foreclosures and evictions. Recessions typically see spikes in foreclosures and evictions as homeowners and renters can't make payments. These forced displacements transfer property from occupants to owners, often investors who buy foreclosed properties or buildings with delinquent tenants. The tenants who lose housing become renters paying higher costs. The homeowners who lose homes become renters. Ownership concentrates upward while the formerly housed become permanently insecure tenants. Bankruptcy implications. When businesses fail during recessions, assets are sold in bankruptcy at distressed prices to buyers with cash or financing. These buyers often include private equity firms, wealthy investors, or larger corporations absorbing smaller competitors. The business owners who fail lose their investments and often face personal financial ruin. The buyers acquire productive assets cheaply and profit from them once conditions improve. Bankruptcy law's structure favors secured creditors and sophisticated buyers over unsecured creditors, workers, and suppliers. The question isn't whether recessions transfer wealth upward, the data proves they do, but whether this is deliberate policy or unfortunate side effect. The evidence suggests it's deliberately designed, or at minimum, policymakers understand the distributional consequences, but choose policies that benefit the wealthy anyway, because the wealthy have disproportionate political influence. The Federal Reserve's explicit policy of quantitative easing is designed to boost asset prices, which the Fed acknowledges benefits asset owners disproportionately. Fed officials justify this by arguing that higher asset prices create wealth effects that stimulate spending, and that supporting financial markets prevents worse outcomes for everyone. But the distributional consequences, enriching the wealthy while doing little for those without assets, are known and accepted as the price of the policy. Congressional bailout programs consistently structure relief to favor corporations and financial institutions because those entities have lobbying power and make campaign contributions while ordinary workers have limited political influence. The CARES Act's $2 trillion in pandemic relief included substantial corporate bailouts and support for large businesses, while direct payments to individuals totaled much less and were temporary. This allocation reflects political power, not economic necessity. The aftermath of each recession reveals the permanence of wealth transfers. Wealth lost during crisis isn't fully recovered by those who lost it. A homeowner who loses a house to foreclosure doesn't typically become a homeowner again. That house is now owned by an investor or a wealthier family. The workers who lose jobs during recession often take new jobs at lower wages, permanently reducing their lifetime earnings. The small business that closes permanently transfers its market share to competitors that survived. These transfers aren't reversed when the economy recovers. They're permanent redistributions from those who were vulnerable during crisis to those who were resilient or opportunistic. The implications are profound for understanding economic inequality. Much of the extreme inequality evident today, with the top 1% owning more wealth than the bottom 90%, results from these repeated recession-driven wealth transfers compounded over decades. Each recession strips wealth from the vulnerable and concentrates it among the wealthy. The wealthy use that increased wealth to capture more assets during the next recession. The cycle repeats, with inequality ratcheting higher after each crisis. Research tracking wealth inequality across the 2008 recession and recovery confirms this. Wealth inequality declined temporarily during 2008-2009 as asset prices crashed, temporarily reducing the wealthy's net worth. But during the recovery from 2009 to 2016, inequality not only returned to pre-crisis levels but exceeded them. By 2016, the wealth distribution was more unequal than before the crisis, with the top tenth capturing the vast majority of recovery gains, while the bottom half saw minimal wealth growth or actual declines once accounting for inflation. The Federal Reserve's own data shows the top 1% of households held 23% of all household wealth in 1989. By 2019, they held 32%. The bottom 50% held 3.7% of household wealth in 1989 and just 2.1% in 2019. The 2008 recession and recovery accelerated this concentration. The 2020 pandemic recession and recovery accelerated it further. Each crisis is an opportunity for those with resources to accumulate more at the expense of those without. The personal strategies for navigating recessions profitably, if you have resources, are straightforward and well known. Maintain liquidity going into downturns so you have cash when asset prices crash. Use credit access to leverage purchases of distressed assets. Buy when others are forced to sell. Hold through recovery and profit from the rebound. Warren Buffett's famous advice to be fearful when others are greedy and greedy when others are fearful encapsulates this approach. The 2008 crisis allowed Buffett to invest billions in Goldman Sachs and Bank of America at highly favorable terms during the crisis, generating billions in profit as those institutions recovered. The pandemic crash allowed opportunistic investors to buy stocks at March 2020 lows and ride them to record highs within months. But this advice only works if you have resources. Someone living paycheck to paycheck can't maintain cash reserves for opportunistic investing. Someone who loses their job during recession must liquidate savings and assets to survive, not accumulate more. Someone without credit access or wealth can't buy distressed properties regardless of opportunity. The strategy that works for the wealthy is unavailable to most people, ensuring that recessions continue transferring wealth upward. The political implications are that neither major party seriously addresses recession-driven wealth transfers. Republicans explicitly favor policies that benefit capital over labor through tax cuts skewed to the wealthy and opposition to labor protections. Democrats provide more robust social safety nets and sometimes propose wealth taxes or higher top marginal rates, but when crisis hits and they control government, as in 2009 and 2021, their responses still prioritize asset price support and corporate bailouts over fundamental redistribution. The Obama administration's response to 2008 saved banks but did little for homeowners. The Biden administration's response to pandemic recession included substantial direct payments but maintained the Fed's asset price inflation policies that primarily benefited the wealthy. The structural bias toward policies that benefit asset owners results from campaign finance, lobbying, and the composition of policymaking elites who are themselves wealthy or closely connected to wealth. It's not conspiracy so much as incentive alignment. The people making policy personally benefit from policies that inflate asset prices and protect financial institutions. They genuinely believe these policies are necessary for overall economic health. And the political contributions and influence that wealthy individuals and corporations wield ensure policies continue favoring their interests. Breaking this pattern would require fundamental reforms, restricting Fed's ability to inflate asset prices, preferencing direct support to workers and homeowners over bank bailouts, strengthening progressive taxation, particularly on wealth and capital gains, empowering labor to capture more of productivity gains, restricting political influence of wealth, and ideally creating alternative economic institutions like worker cooperatives that aren't structured to transfer crisis gains to capital owners. None of these reforms are politically feasible given current power distributions, ensuring future recessions will transfer wealth upward just as past ones have. Understanding how the rich profit from every recession means recognizing that crisis isn't shared suffering. It's opportunity for those positioned to exploit it. The next recession, whenever it comes, will follow the same script. Asset prices will crash, creating panic among ordinary holders who sell at losses. Wealthy buyers will accumulate assets at fire sale prices using cash reserves and credit access. Government will bail out financial institutions and provide stimulus that reflates asset prices. Recovery will drive asset values above pre-crisis levels, and the wealthy who bought at the bottom will profit enormously while those who sold or lost assets will be permanently poorer. The pattern is predictable, documented, and apparently unchangeable given current political economy. If this gave you a new perspective, hit subscribe. Recessions don't hurt everyone equally. They systematically transfer wealth from those who must sell assets to survive to those who have resources to buy at the bottom. The data proves it. Billionaires gained $1.7 trillion during pandemic recession while millions lost jobs. Inequality reached new highs after 2008 recovery despite temporary decline during crisis itself. Asset ownership concentrates with each crisis as forced sellers lose property to opportunistic buyers. Government policy reinforces this through bailouts that save institutions over individuals, and Fed policy that explicitly inflates asset prices benefiting the wealthy. The recession isn't coming to hurt the rich, it's coming to enrich them further, to transfer your distressed assets to their portfolios at prices you can't refuse because you need cash now and they can wait for a recovery. The economy doesn't crash for everyone. It restructures ownership, moves assets from weak hands to strong, from the desperate to the patient, from the many to the few. And when recovery arrives and everyone celebrates growth returning, the celebration obscures that growth's benefits flow disproportionately to those who bought your assets, your home, your business, your stocks at prices depression forced you to accept. The rich don't fear recessions. They position for them, wait for them, profit from them. And when the next one arrives, the pattern will repeat, wealth will concentrate further, and everyone will pretend it was unavoidable rather than the predictable outcome of deliberate choices about who policy serves and whose suffering gets relieved versus whose opportunity gets protected.